How do I finance my first investment property? Now, this is a question over the last 23 years that I've been getting on a regular basis, and I would say it's one of the top 10 questions that I'm getting. So if your first thought is just go to the bank, then you're not thinking like a property investor yet. So a real property investor will ask, but what structures give me the best control, the most profit, and the best protection? You see, here in South Africa, where we are at the moment with the government that we've got, one of the main things that we need to do is to know how, for example, how to protect ourselves against the banks, how to protect ourselves against the government. In any investment, there's two parts to investment. The first part is the risk part, and the second part is the growth part. It forms part of an investment. So we need to be in control of the risk as well as the growth, right? So as a wealth creator, we must learn how to create, to grow, to protect our wealth. Why do we need to protect it? Because if I look at the wealth creator strategies, intelligent use of limited resources to go from where you are to where you want to be in the shortest possible time with the least amount of risk. Risk is when you do not know what you're doing. In other words, if I do something and the banks are going to take me for a ride, or the seller is going to take me for a ride, or the government is going to take me for a ride, and I do not know that, or there are legal requirements that I have to meet that I don't know about, then I'm at risk. And therefore, the protection part becomes the biggest part. Now, when it comes to the financing of property, and this is what this training session is about, the protection part becomes crucial that we understand what it is. And the only way to offset that is to have high-value mental skills and high-value financial skills. Right. And the moment that we've got that, and hopefully I'm going to be able to help you and add value so that you can help yourself during this specific video. So the question at the end of the day, why do I want to protect and why do I want to grow? Well, the only reason is I want to make sure that my investment growth rate, the money that I'm going to put into this specific property, that the growth on that is going to be more than my financial freedom growth rate. So the biggest risk that you can ever take in your life is if you're making an investment and your growth on that investment, your investment growth rate, is not bigger than your financial freedom growth rate, your FFGR. That is the biggest risk. And all these risks shows in just that one calculation, believe it or not. Right. Now, in property, when I invest or before I invest, there are 7 basic laws. There's actually 8 laws that I'm looking at. But the first law, we call it the 0th law. The 7 laws of a property investor, but the 0th law is, do you really want it? In other words, if you are not prepared to put in the time and the effort in order to figure out how this works and where and how this is going to fit into your financial freedom plan at the end of the day, don't waste your time with property, because I can tell you that it's not working. But then there's also the 3rd law. And the 3rd law is basically to take control over the deal. So if I'm going to do financing, there are different ways, and I'm going to give you a couple quickly in order to get you on the path. But there are certain risks attached to each and every one of these financing methods that you can use. But you can take control over that deal. In other words, you can't take control over the deal unless you know the outcome of that. And that means we have to look at the result. The result is always that my IGR must be bigger than my FFGR. Only when I see a result, only then can I manage it. Can you see why it's so important that we have to apply the 3rd law of a property investor before we actually invest in property, or we start with that investment? Now, if you're not going to do this, it simply means that the banks are going to call the shots, because 95 to 98% of all people that buys, especially their first home or house, will be using the bank, right? And the banks are set up to keep you poor, right? So you are at enormous risk. It's only when you understand their game that you can use that against them or to your benefit. But most people are not prepared, and that is why the 0th law is so important. Most people are not prepared to put in the time and the effort to apply the first law, to invest in themselves before they invest in property. And that is where the biggest problems comes from, right? So the banks are going to call you the shots. Now, why do I say that? Because that house that you're going to buy, if you're using the bank, it simply means that the deal owns you, not the other way around, because that house is not your house, right? You are at risk on this property because there's the property and there is your personal name, and the bank are going to require both security on the property as well as security on you as an individual, irrespective of the entity that you're going to buy that. And you then becomes your ID, so to speak. Your personal becomes liable. So if the banks take that property back and you own R1 million on it and they sell it for 100,000, which by the way has happened more than once in South Africa, you still owe them 900,000 rand, right? Even if they pull a trick on you, you still have to do it. Not only do you lose the house, but you lose 900,000 plus interest in terms of the risk that you expose. In other words, the banks owns you. You have to understand this. And this is why it is so important to start to understand and how to protect yourself, because otherwise you're playing their games. Now, the banks love security, but they love security not in the way that we think. They love the security that you've got a job. That is the basis that they use. They are not really interested in that property, right? They are interested, can you afford to repay your monthly installments? In other words, that is where the banks are going to come and say, but if you haven't got a job, it's going to be very difficult. There are other ways that we can do it if you're a serious property investor where you don't need the banks. But for the average person that starts, they need the bank to start, or they think that the banks are important, right? But we as investors, we love leverage, we love creative terms, and we love smart money. What do I mean with that? We love it that we can put a deal together where the property is not the main thing that we focus. The property is just the instrument that we use in order to get our growth rate. So our fancy, so to speak, is that growth rate. If that growth rate is more than my financial freedom growth rate, I'm in. Otherwise, I am out, and I'm not interested in property as a property investor. So I'd like to give you a tip, if I may. Your job as a smart property investor, right, isn't to qualify for a loan. Most people think that this is their job. They have to qualify for a loan and then they can buy a property. Worst thing that you can do is to have this attitude. Your job is to structure a deal, a property deal, so well that the financing becomes irrelevant. If you know how to do that, you're a property investor, you're a master property investor, you're a wealth creator. Right, let me give you a simple example. When I started my career, that was about, I started in 87, beginning to understand this, but in the early 90s, I developed a property. Right, it was an existing property, but I changed the function of the property. In other words, residential to commercial property. But in that process, no bank wanted to finance me. But because I understood the deal, I could see that irrespective of the way that I'm going to get the money and the interest that I have to pay on that, it's still going to be a deal. And eventually, I clinched that deal and I had to pay 4% above prime. Now, most people are going to say, no ways, this is not a deal. But I took that deal. Why? Because the sums still made enormous sense. And within 6 months after I've taken that 4%, I did another deal on that specific property where I got it at 2% below prime. But I first had to establish and I first had to prove that this deal was really a deal, because the banks could not see that. And this is what I'm trying to get over to you, that your job is to structure the deal so well that the financing becomes totally irrelevant. And if you know how to structure that deal, you'll always find the money. This is what we show people in the property mentoring course. Right. Now, let's look perhaps, because I'm here to add value, at one or two different options in terms of how you can get money if you want to buy a property. The first one, by now you know, is a traditional bond. You go to the bank. If you're a first-time home owner and you buy in the vicinity of R1 million and you are credit worthy, the banks are going to give you the money and even more money than what you need, right? So they will go not only on 100% bond, but they can go as high as 110%. But the problem with this is if you do it the conventional way, then I can tell you that you are busy not protecting your future and you are taking huge risk, right? Now, the only way to know if it's going to be a great deal is if your IGR is lower or higher than your FFGR, if your IGR is bigger than your FFGR. But 98% of the people over the last 23 years that I've looked at, right, could not do that simply because they did not know and they did not invest in themselves before they invest in property. The IGR, therefore, on these kinds of property, 98% of the time are poor. This means, and it shows me, that people do not have skills. And here's the problem. No one is going to teach these skills to you except at the Wealth Creators University, for the simple fact that the mainstream media and the financial industry and the educational system, they do not want you to know this stuff. Because the moment that you know that you can get 50 and 80 and 120% on your investment, you're not going to buy and be part of the mainstream media anymore, right? So this bank can only work, and by the way, the majority of my properties when I started off, I bought through bank financing, right? I used the banks, right? And I've mentioned that sometimes even 4% above prime, and it was still a deal, right? But the main thing here is that I only did it when my IGR, my investment growth rate on that property, was more than my financial freedom growth rate, right? There's another way that we can do it, and that is seller finance. And maybe you can go and Google that and get it for yourself. But it's exactly the same calculation that we're going to do. Your IGR must be bigger than your FFGR. Just because you can get seller financing doesn't mean that it's going to be a great deal. For most people, it will never be a great deal, right? So the risk remains extremely high and the protection is extremely low if you do not know what you're doing. And therefore, although there's a lot more flexibility when it comes to that, you still need to know how to do the sums and what you can and what you can't do. And one of the things that I can tell you, even if you're a seller or a buyer trying to use a seller financing, make sure that you get the right and professional people to help you to draw up the contract, and that you know exactly what you let yourself in before you actually sign that contract, right? Another advantage that you may have, certain circumstances, depending on the contract and depending on who helped you, is you can delay transfer duties. But for most people, it's not a big problem, especially when they start. But it is possible, and I've bought properties by using this method with delayed transfers, right? Also, maybe you don't need to put in any upfront money. And by using this, you can become very creative. And I've done this later on in my career many, many times. And I'm still doing it, by the way, right? Another option that you may have is the so-called rent to buy. And again, this, just because you can rent to buy, which 99% of the time, maybe 99.9% of the time, is not going to work out, because the seller is normally a developer, or he knows how to do the calculations. There's even firms that specializes into this. Your IGR is not going to be bigger than your FFGR. But there may be the exception. There's always an exception, especially if you find a person, the right, let's call it seller. And by the way, in the 7 laws of a property investor, I'm showing you also how to find motivated sellers and where to find them, because it's part of that control that you're going to have, right? Is you must make sure that you've got control by having the right contract in place and that you know exactly what to do. And for that, you need to get the right people to help you, right? Again, it's great for perhaps first-time buyers. In my case, it wasn't when I was a first-time buyer, but because I know this information and stuff, you can use it to excel your portfolio, especially when the banks are getting tight and they say, no, you don't qualify and blah, blah, blah. And man, the bank's got no bloody idea what is going on. But the condition stays, your IGR must be bigger than your FHR. The last one that I'm going to touch on quickly is partnerships. Now, we should be very careful for partnership, because if the partner goes bankrupt and it's a real true partnership, then you've got a serious problem, and that is that asset they can take control over that full asset, even if you've paid half of it already. So there are better ways than partnerships. But when I'm talking in terms of partnerships, let's make it a little bit broader. You can do it, for example, in a company, and you can do it even in a trust. So there are different ways where we say, this is my partner, but it's protected by a legal entity and a legal structure. And in that case, partnerships can work, especially if you know what you're doing. And again, these are the things that we share with the inner circle and show you how both you as well as the partner can benefit. And it's one of the quickest ways for you to excel if you find the right partner. But again, it's only when your IGR is bigger than your FSGR. Can you see that I can't stress this enough? Because 98% of the time that I'm dealing with people as a mentor and I see what they are doing, because all of this knowledge accumulates and it forms like a database. So that gives me, I can almost say, the right to say that I can very, very quickly, within 5 minutes, tell you if this deal or this structure is going to work or if it's not going to work or what you need to be looking out for. Right? So this risk with a partner, if you do not structure that deal in the right entity, can cause a lot of harm to you, right? So there are ways to use partners where you can get everything for free, right? And as I've said, I'm sharing this with the Property Pro mentoring students as well as with my inner students, right? So please be careful for a normal partnership. And remember, when you and your wife are buying a property, right? And both of you are standing security, the spouses becomes partner, right? So maybe a tip, something to think about it, something to just put in the back of your mind to say, okay, I need to find out a little bit more about it. Now, all of this that I've said becomes totally irrelevant if the sum doesn't gel, right? So it's the math that matters. Do the sum. Let me quickly give you perhaps an example, and then you can have a look at this, just a quick way to frame your mind. Let's assume I'm going to buy a property for the value of 850,000. I can get 100% bond for it, 850,000. There are no costs involved. I get the bond over the 20 years, so it's 11.5%. Now, of course, we all know that it's fluctuating, but let's say for now it stays the same. That means my repayment is going to be about 9,106 rands per month for the next 20 years, unless something changes. But luckily for me, I can rent this property out for, let's make it 7,500 rand. But on top of that, I have to look at the levies, the rates and taxes, the insurance, all of those costs. And let's put all those costs together and let's say that is 2,500 rand. Now, we look at cash flow. Cash flow means I'm negative. I'm out of pocket 4,106 rands per month. If I add this up, it means that this property is going to bleed 49,272 rands per year from my surplus. So if I do not have this 4,106 rands per month, even if I've got a tenant, I cannot afford to buy this property. Therefore, this 4,106 rand, this is my surplus. This is the amount of money that I need in order to help me to become financially free. This is what I figured out in 1987 when I developed the Property Pro investment system. So here's a question that I'd like to ask you. How on earth do you know if this is a great investment, yes or no? Can you see? Because if that money is not growing enough and hard enough in that property as the investment instrument that you're using, it's a no deal. Right. So now we have to compare it to our financial freedom growth rate, our FFGR. What is the financial freedom growth rate? This is simply how hard must your money work for you in that property, that 4,106 rand, so that it can help you to become financially free. That's all. Now, hypothetically, we're going to put a scenario and say you need an additional investment wherever you want to make the investment that's going to give you 10 million in 10 years' time, right? From where you are to where you want to be in the shortest possible time, part of the wealth creator strategy with the least amount of risk. So what's the risk? The risk is if I do not get that growth. So if I've got 4,106 rand for 10 years, on a normal Excel spreadsheet, we see we need a growth of 46.44 compounded yearly, but calculated monthly, right? So the yearly is 46.44, but the 4,106 per month, we start getting it's growth on growth. Otherwise, we'll never get to the 10 million. And check that self for yourself in terms of a normal Excel spreadsheet. And if you don't know how to do it, Google it. This is crucial that you understand. We've got a course on how to do this calculation the right way. This is, we call it your freedom number, 10 million, and that's a quick way to explain this. So now that we know it's 46.44%, now we're sitting with a small problem, because the deal is my IGR, the deal on this property, is not more than 46.44% over a 10-year period. We know it's not going to work. Now, if I look at this deal in the first year, it's a negative growth in terms of its cash flow is depleting my surplus, my cash flow, right? That simply means if I can't get enough capital growth, and I can tell you now that there's no frickin' ways on this planet Earth that in South Africa over the last 5, 7, and 10 years, you could have get that growth that's going to make that the difference up. It's a no deal. Can you see how simple it becomes to invest in property? Now remember, the financing, and we're talking about financing. Financing makes up a portion of this deal, because in the financing is going to determine the interest. But the interest is just part of the term. And the term is part in terms of the way that you structure. Is it an access bond? Is it not an access bond? Right. Because you can use an access bond in different ways. But also there are ways that you can buy a deal and pay only the interest portion and no capital, right? You use the rollover and balloon. Nowadays they are more difficult to do that, but you can still do it, right? So I hope that you see that unless you've got a system, it's going to be impossible, at least for me. I'm not good with math, and therefore I'm using a system. But it's impossible to take all these variables into consideration to give you an outcome that you can rely on in order to make an informed decision. Right. So on top of this, even if the sums gel, then legally, from the laws of the land, you still need to pay attention to a couple of things. Remember, my job is here to train you as part, let's call this is a mentoring session. This is normally the way that I would do it for my students. We need to quickly look at these laws that apply in South Africa and basically the rest of the world. Right. Now, before we do that, perhaps let's quickly validate the 7 laws of a property investor. The first law is invest in yourself. In other words, gain the skills before you make a deposit. 98% of people are not going to do that, and therefore they're going to break this law. Second law, cash flow is more important than paper assets. What do I mean with a paper asset? You're going to say, honest, but I've got a property. This is my property. And it's true, but it's not your property because it belongs to the bank as long as there's a bond over that, right? So the deed belongs to the bank. The title is yours, but the title deed belongs to the bank. In other words, they're going to transfer because the government wants the money on the transfer and the cost, and the attorney needs to be paid, and the bond originator needs to be paid, but the title deed belongs to the bank. So therefore, you've only got a promise that if you pay this mortgage for 20 years, then it becomes, because then they transfer the title deed into your name. So this is a paper value. Now, there's another reason. On books, it may look like a great deal, for the simple fact that you say this property is worth 2 million and I only owe 1 million. But that equity is not real until you sell. And if you're in a difficult market, you're going to find out that what you think is the market value is not going to be the market value. And this is why it's so important in the mentoring course that you understand what are the risks, how to offset that risk, and how to make sure that you get the market value when you should be getting the market value. The third law says, are you in control? And we've talked a little bit about this when it comes to financing, but it's not only in terms of the financing, because the financing is actually part of a whole process, because the financing is going to depend on a bond originator most of the time, because you're going to take that to a bond originator that's going to negotiate. But do you know that you're in control on condition that you know how to control? But there's attorneys involved, and you can be in control. 99% of the time, people are not in control of that, right? With the evaluation of the property, you're in control, but 99% of the time, people don't know their rights, and therefore they don't know how to do it. But all of this makes part of the financing deal that you are going to sit with. And therefore, make sure that you understand and that you are in control. If we look at the fourth and the sixth law in short, is if you didn't negotiate, if you just accept the terms, then you can't say that you've applied these laws, because by simply doing these laws and structuring the deals right, by the way, SARS is part of the negotiations, and you don't have to actually go and negotiate with SARS. You set up the structure where you do the negotiation based on law, where they have to do certain things, right? Even if they don't like to do it, they have to do it. So the moment that you do not know these laws and how to apply, and this is why I'm showing this to you, then you are not investing. You are hoping that property is a great investment. Now, I've started and then I went on a tangent here in terms of the 7 laws, but then there are legal checkpoints that we have to check in terms of the laws of the country. One of that is the National Credit Act. So especially if you want to make use of outside of the bank, like seller financing or rent to buy, you still have to apply to the National Credit Act. So make sure that you understand that, or that when you buy from someone, that they are aware of this. Or if you sell the way that I've explained to someone using one of these strategies that I've showed you, or techniques, that you still make sure that that person applies and adhere to the National Credit Act. I'm not going to get deep into that. Another thing is the Income Tax Act. Every single way that you buy a property can have an effect in terms of income tax, in terms of VAT, in terms of capital gains tax, right? And you need to understand the basics, right? And be in control of that. Now, if you're going to buy a property in your personal name and there is a loss in that property, like in this case that I've showed you with the 850,000 Rand, you're going to find that there's a loss, and if that is the only property that you've got, you can't offset that property like in the past against other income. That means you're going to pay tax on this, and then on this property there's no deductions that you can get, right? Because that interest portion, which is the biggest part of the expense, you will not be able, because of ring fencing, right? Now, the same thing happens with a company or a trust. Now, think about this. If you buy in a company and there's a negative cash flow and there's no other income in the company that you can use, you have to subsidize it from your income. This means that you first have to pay tax. Now you put it into that, and there you cannot deduct that. It becomes an accumulated loss. Now, luckily, if you've got a system, it takes all of that into consideration to show you the real IGR on that specific property. Right. There's another thing that I just want to throw in quickly, and that is the Trust Property Control Act. So on the trust, if you're going to think of buying it in a trust or structure it through a trust, there are certain controls. But what I like about trust is it's actually a contract. So if you've got someone else that is clever enough and that has got the experience, they can guide you, because there's a lot of benefits that you can get and protection that you can get through trust, on condition that you understand the law and how this trust works. Right. Now, I can tell you right off the bat that the majority of people have got no idea how to actually use and benefit from a trust. That's, by the way, one of the reasons why we've got the Trust for the Entrepreneur and Investor course on that a lot of auditors and financial planners and attorneys have attended and told me, Hannes, we've never knew about this from a financial planning point of view. So you need to know how that trust deed works. But the trust deed is actually a contract. So whatever is in the contract, this gives you what you can and what you can't do, on condition that there are resolutions and that you follow the process. So perhaps before you do this thing, especially if you are considering a trust because someone else told you about a trust and that you can hide, it's bullshit. You can't hide anything from SARS, right? Make sure that you understand what your legal rights are and how to use that structure in order to benefit you. Because, as I've said, a trust is just a contract, right? Now, there's a ton of information, and I hope that you see that I want to add value. But none of this is going to mean anything unless you start taking action. So if it's okay with you, I'd like to give you almost like a summary of what we've done here today, and then give you a strategy, a kind of a strategy, the right strategy. The intelligent is a wealth creators university, is a wealth creator strategy, which is intelligent use of limited resources to go from where you are to where you want to be in the shortest possible time with the least amount of risk. But let me give you a plan. First thing, if you've never bought a property, then you perhaps in the best place ever. So first, learn before you invest. If you're going to invest in property, you are going to make all the mistakes that most people, 98% of my students, have made before they joined the university. Right? You can sort out all of that out without losing a cent, because you learn as you go through the process. In other words, property is the only investment where you can gain practical experience without having to pay the price. In a unit trust, you first have to give them the money, and then you're going to see what's happening. The pension fund, provident fund, retirement annuity, anything. With property, it's a different way, because I can do the calculations before I invest, and I'm going to show you how to do it. So learn before you invest. I've bought my first property after I've evaluated 133 properties. And when I found that free property, I understood how everything works, because I've gone mentally through the process of buying 133 properties without paying a cent for those properties. I hope that you can see, right? And you've got only one chance. The second thing that you have to write down and then start doing is understand the structures on how to protect your investment. Right. Now, we should be careful. Your house is never an investment. And I've got courses and free videos to show you why your house is one of the worst investments that you can ever make in your life. But if it's a property investment, then you have to have and understand how to optimize, especially the risk part to it. The last part, which is by far the most crucial, and I've showed you on an Excel spreadsheet how to calculate your financial freedom growth rate to determine that your IGR, if it's going to be bigger than your FFGR, so that you can get that in place. And that is, make sure that your IGR in that property is bigger than your FFGR. If it's not, my friend, it's not going to be an investment. It cannot be an investment, right? So therefore, before you finance anything, I suggest use something like the Property Pro investment system. Run the numbers, make sure that you compare that your IGR is bigger than your FFGR, and then structure the deal in order to protect you. Right. Now, if that IGR is not bigger than your FFGR, what do? This is my plan for you. This is the strategy. This is you walk away. Why? Because I will walk away. Right? It makes no sense to waste time and effort and money and take yourself out of the market for the next 20 to 40 years because you've made one stupid decision, right? And you can protect yourself against yourself and not make that mistake that 98% of so-called property investors are making. So let me give you a tip, if I may, only if you're open-minded, right? Success is not in getting the deal. It's in getting the right deal. Any Tom, Dick and Harry that's got an income that is credit-worthy can go to a bank and buy a property. And the banks are taking these people left, right and center. For Tom, Dick and Harry, they are taking them for rides. And Tom, Dick and Harry does not know and do not know that they've been taken for a ride. And I've got free YouTube videos that I can show you why I'm saying what I'm saying, right? And you're going to say, but why the hell? Maybe you are Tom, Dick and Harry, right? Why the hell did I sign that deal? Now, here's the deal. If you have signed a deal like that, there are ways out. There are ways out, but you need to think differently from the way that you are thinking at the moment. So success is not getting the deal, my friend, it's getting the right deal, where your IGR is bigger than your FHR. Now, I'd like to try to help you if I can, and if you think that I can help you, not only myself, but my team. And that there's a lot of people that are unsure, and they want to get a little bit more guidance, and this is why we are mentors. So if you want a personalized property roadmap built specifically for you, then maybe I can help. Because the way that I've seen it over the last 23 years is that most property investors don't fail because of the economy. They fail because they've made one bad decision. Just one, right? Maybe it's the way that they structure, maybe it was the finance, maybe it's the strategy that they're following, and maybe they did not do the calculation, which 98% of the time that is the case, because that calculation would have showed you where you are going wrong, right? And therefore they buy this. This is going to cost them years of progress. Let me tell you why. If you've got 4,000 Rand, like in this case, and that is your only surplus that you've got, you're going to tie this in for the next 20 years, minimum. Because most people are going to refinance and build on. And most people within 7 years will either get a better bond or bigger bond, or they're going to buy a bigger house. But the moment that you're locked in that means that 4,000, if it's not growing for you at a higher rate than your financial freedom growth rate, you cannot get ahead. That means all the opportunities in the future you won't be able to take. That means, and look at your friends and family around you, you find that people has got and been in property for 20, 30, 40 years, and then when they retire, they still got a bond that they have to settle from the retirement, the gratitude, the gratuity, the third that they're getting in cash, right? They have to settle it. This is not the way to invest, my friend. And for that reason, it's going to cost you freedom by making one wrong mistake, right? In other words, don't make that mistake. Prevent that mistake by putting in this that I've given you, and that each and every time that I'm answering a question, right, make sure that you apply that. So now, we do not want this to happen to you. Finishing class, right? So that is why, and this only applies to people that are serious and that is willing to do what we suggest that you do. So if you are serious about property, we love to build a custom roadmap for you, right? Based on your current investment level, based on your current resources that you've got. We're all different. There is no plan that applies to everyone. Anyone that tells you that there's one fix for all the problems in the world lies to you, right? Especially when it comes to property. So your resources, your time, your effort, your mindset, your skill set, your money, your gifts, your goals are going to be totally different from anyone else. We're also going to look at your financial freedom goals, if you've got any. And if you haven't got any, we will help you to determine a goal that makes sense to you, because there's a specific way that we can help you to do it. Now, this little plan or roadmap is called your personalized wealth roadmap, right? Now, by doing this, I think because of all these experience that we built up over the last 23 years by dealing with numerous and different classes and different levels of individuals, from multi-billionaires to people that hasn't even got a job, right? I think that we can guide you in the fastest, the smartest path and the least riskiest path to go from where you are, wherever you may find yourself at this stage, to where you want to be, and I hope that is financial freedom, by using property as your main investment strategy. Not the only investment strategy, because we're going to look at other things as well. Remember, this is not advice. This is what I would do if I were in your position, and it's a strategy that you can follow. This, in short, I think is the powerful property assessment. Now, you have to do something a little bit before we can actually help you with the process. And this assessment is going to help you as well as us to identify the biggest problems, the biggest opportunities that you've got, and how to build on that. Now, it's going to show you what skills and strategies you need to take in order to move on to the next level. Because remember, the wealth creator strategy, intelligent use of limited resources to go from where you are to where you want to be. But that limited resources, in order to become successful, I need to get the right information, the right skills in the right order for the level of the game that I'm at. And then I have to apply it to see what the outcome is going to be. And the outcome should be that your IGR is bigger than your FFGR. If not, you've got a problem. And with our experience that we've built up over the last 23 years, I think we've found a methodology, we call it the Wealth Creators Method, to apply the wealth creator strategy step by step to tell you and to help you to go from one level to the next one. Therefore, this assessment form is going to help us to understand how we can support you personally. But please, please, only do this if you are serious. Now, if you qualify for our mentorship program, right, we'll show you exactly how it works and how that can benefit you. What if you do not qualify? No problem, because we'll still give you a full feedback on what the next steps are that you need to take, right? There's no pressure, there's nothing, it's real value. Now, why do we do this? Because we know that if you're going to apply that, you are going to be ready to get onto the mentoring program where we can speed up this whole process for you. Again, only if you're interested in this. Now, if you are interested, and if you are prepared to take the responsibility, and if you are prepared to do the things, in other words, not just get the information, but do something about it, I want you to, in the comment section, put in the word roadmap, right? And this is where we start with that analysis, where you're going to get your free property assessment done. And as I've said, we'll come back to you as quickly as possible, right? Or at least come back to you and say, listen, we've received it, and then keep you in the loop, right? Because our resources, manpower, is quite limited. And therefore, if you are not serious, please help us, and so that we can help a lot more people. It's no good if you're not serious to do anything, right? So if you do that, we will help you to map out your future with the experience that we've built. Now, that's not the only way that we can help you today. We can also help you if you want, and you're serious and you want to learn a little bit more. And that is to simply join our free accelerator masterclass, our property accelerator masterclass. Now, this is an incredible, I'm going to share 3 secrets with you, the biggest mistake that people make, show you a very quick fix to that. I'm going to talk about the levels and show you how to help you with that levels, or how you can help yourself with that levels. Now, to do that and to book is, you'll find in the description area, you're going to find a link. You simply click on that link. That's going to open a form. You fill in the form. There's a page where I'm going to give you a welcome, and there's a special deal that I'm going to make normally. I'm not saying that my team is always going to do it, but think about that, because you're not going to see that deal ever in your life again, right? That is only if you want to. But then there's an option to go to the masterclass free of charge, no cost, and then we'll take you through the whole process, right? So, and just by doing that, you're going to save yourself a ton of money. And then from there, we're going to guide you to more resources that you can follow. So perhaps, and I know that I've given it more than enough, but just for today and just for this video, let me give you another bonus I think can help you, because it has saved me tons and tons of time and effort and money, right? So that you can help yourself. And that is, I want to give you access to the 7 laws of a property investor. Now, by the way, if you're going to attend the Property Accelerator Masterclass, as a bonus, I'm going to include this. But I know some of you are a little bit lazy and you don't want to go through all the hassles to get it. And therefore, I'm going to give it to you. Right. The 7 laws of a property investor in order to get to financial freedom. Right. So most property investors fail because they break these laws without knowing it. I'm going to give you the laws quickly, but then I've got a PDF and I'll show you how to get that PDF. So what are the 7 laws of a property investor? First of all, the 0th law, you have to want it. If you do not know why you want to be financially free, or why you want whatever you want in life, what your goal is and why you want to achieve that goal, no one can help you. That is to do with your mindset, which is the first basic investment skill that you need, high value skill, and that is high value mental skills. And this is where we start. Once you know what it is, and in this I'm going to share my story with you on how I started and why I started doing what I'm doing. The first law is very simple: invest in yourself before you invest a cent in any property. The second law is cash flow is more important than capital, and I'm going to show you examples and proof of that, and why we buy properties where other people will not dare to buy properties. The third law is take control of the deal, and the deal consists of a lot of things. The fourth law, always buy from a motivated seller. And sometimes, in terms of a motivated seller, does not mean that you're going to get a great deal. But because that person is motivated, we can structure a deal that's going to benefit the seller as well as ourselves. Crucial that we understand how to apply this fourth law. For example, I've bought in November last year a deal to the value of 10 million. Right. The seller were not, in the typical sense, a motivated seller from a financial point of view, because he's well off. He doesn't need the money. But he was a motivated seller. And I had to find out why he wanted to sell that property at that price. Right. Once I understood that, I could then proceed. So I've applied the fourth law, even though most people will say, yeah, but it's only when it's a bargain. No, it's not when it's a bargain. That's not the purpose of the fourth law. But you need to understand the fourth law, and you're going to find out a lot more about that. Now, what's the fifth law? Don't become emotionally involved. In other words, do the sums. Isn't this what I'm telling you in all these questions that I'm answering you? Is do the sum. The sum is going to tell you, stay out, emotionally get out of the way, right? Do the sums. If the sums work, then becomes emotional, because the emotion is going to be your why you want to be financially free. The sixth law, negotiate your way to freedom. And again, it's not that most people are not great negotiators at all, but there are ways that we can negotiate without the other person knowing that we are busy negotiating. For example, with the estate agent, I can do negotiations like crazy, and that person doesn't know it. And then he or she has to do the negotiation with the seller. The same with bond originators. So there are ways that make sure that you understand the sixth law. And the seventh law is plan and protect your assets through financial structures, especially in South Africa. And this is the main reason why I want to give you the 7 laws of a property investor, because if you do that and if you apply that, you will get the benefits from this video, right? And that's the thing. All you have to do that, right, is to type in the word 7 laws, make it a 7 and then laws, right? In the comment section, we're going to get back to you, start this process and direct you on how to get the 7 laws of a property investor. So there's 3 options. The one is you can book for the property masterclass if you think it's going to be well worth your time. You will get the 7 laws in that in any case, so you don't have to say 7 laws. All right. The second thing is the roadmap that you have to put in the roadmap in the comment section. We will follow up with you and help you with that. And if you do not plan to go to the Property Accelerator Masterclass, it's too much hassles for you. I don't think you're that type of person, but if it sounds like too much hassles, then just put in the 7 laws so that we can send it to you and that you can start your process. So thank you so much for your time. If you've got any other questions, let me know. And then also, if you found value in this, please spread the word. Please tell other people, maybe like wherever you've seen this, and then share if you think that it can add value. And then I'm going to see you in the next lesson where I'm going to tackle another question in order to be able to help you.